Hi, this is David. Let's take a look at Part 1, Topic 1, Bodie, Kane, Marcus. And the learning objectives we will see concern really the generalization of the single factor capital asset pricing model. In the single factor capital asset pricing model, the single factor is the market's excess return. And the arbitrage pricing theory, aka APT, and the multi-factor models generalize or extend from that single factor into multiple factors. And this allows us to be more realistic with the models. And so we'll start with describing the inputs, including factor betas, to a multi-factor model. Bodie-Kane starts with the simple case here of a single factor model that parses the actual excess return on firm I. So that's denoted here by R sub I, and notice it's an excess return. So unless otherwise defined, excess return implies return in excess of the risk-free rate. And so the single factor model says the excess return is a function here of a systematic or systemic factor and a firm-specific risk. So in this first iteration here, it's the expected return, so it's a bit recursive. In other words, the excess return is a function of the expected return, and then, in which case, because this is expected, it's going to be a beta exposure to any unanticipated macro events. So that means the expected value for this term here is 0. And then we also have the firm-specific event, which also has an expected value of 0. So the expectation for this model is self-referencing and pretty simple. The expected excess return is going to be the expected return plus any surprises either for the systemic factor or the firm-specific risk. So far, that should look familiar to the capital asset pricing model, because we, in both cases here, have a single factor model. And so just a couple notes, the macro factor, as I mentioned, has 0 expectation. Where is the macro factor here in this model? It's the capital F. The firm-specific component of expected return also has 0 expected value. So a multi-factor model should be better, though, because realistically, we expect there to be several sources of risk for the security or for the firm. So the general idea there is that we get a more realistic model. And so we'll generalize now to 2 factors, and so you can see why I'm saying this is really the theme of the reading. We're saying the firm's expected excess return is then a function of its expected return, if there are no surprises, plus beta exposure to the first factor, plus beta exposure to the second factor, and as before, a single firm-specific component. And so, for example, there may be 2 sources of macro risk. In this case, a macro factor would be unanticipated growth in the gross domestic product, GDP, and an unexpected change in the interest rate. So notice, again, the keys here really are unanticipated and unexpected, because the expected value for these terms, again, are 0 and 0 here as well. So it's really going to be a beta exposure to an unanticipated or unexpected change in the macro factor. And also note here that we continue to have, although we've gone from a single factor to multiple factors, it's still a linear model, right? It's a product of a sensitivity or exposure to a factor plus another exposure to a factor. So we have a linear combination. So it keeps it simple. And then I had a slide here just to remind us of the terminology, because terminologies can be part of the most confusing aspect of all of this. But we have here that beta, very generic, very common thematic in finance. It's a factor sensitivity, but it's also called a factor loading or a factor beta. So here we have a beta or factor sensitivity and its corresponding systemic factor.